Well, as promised, I just want to give a bit of a summary of some of the companies that stood out to me during the Swiss Mining Institute in Zurich last week. These are companies that I met with and also a presentation that I saw which caught my eye. So the first one I want to talk about is InPlay Oil. So they were the only oil company there, and I met the team. They're from Calgary, and they're pumping out around 18,000 barrels a day from their Alberta fields. Now, these fields are expected to last about 8 to 12 years, but what caught my eye is their 11% dividend yield, and they've been paying that since 2022, so that's pretty solid for an energy company. It's a simple message, really. They seem to know what they're doing operationally, and I like that they're focused effectively on steady production with a good balance sheet. So if you're into oil with a reliable cash flow there and a good dividend, I think it's worth a look. They basically will continue doing what they're doing, and then with the idea that they will be taken over effectively. That's what's happened before with this previous management, so it's likely that that'll happen again. And the team will go again, something similar. That was the message that I was getting. Riverside Resources is a really interesting company. Now, they've been around for about 18 years, and I chatted with them about their spin-out model. So at the moment, they're an 11 million Canadian market cap, but their model is really interesting. So they've done 78 projects to date. Number 79 is underway for June. They find projects, explore them, build value, and then spin them off into new companies. And they hand shareholders equity stakes in the new vehicle. So they put the team together, package it all up, IPO it, and then shareholders in Riverside get equity stakes in the new vehicle. So it's a model that's pretty unique in the sector. And I think since they've been doing this for 18 years, it's become pretty routine for them, and they've proven the model works. So I think it's a really clever way to play exploration without, let's say, betting the farm. And that 18 years of proof behind them means it's really become routine for them. And I think additionally what's important is that Riverside retains the royalty. And that's key because Riverside is then it's a royalty generator and not a buyer. They're creating, and then by being involved in the spin-outs, they're accelerating the potential for that royalty to pay out much faster. So it's definitely got my attention because I like this very unusual model, and it's a great way to get in at the ground level on new exploration or mining plays in something that's quite an unusual way of doing it. And as I say, with that track record there. Barton Gold, this is a company that I've followed for a couple of years now, and Alexander Scanlon always sets out a good case. So at the moment, they're at a 65 million Australian dollar market cap. They've got 3 properties, all wholly owned, and the region's only gold mill. Now, it's a staged approach with stage 1 leveraging that mill for a low-cost transition to operations, and then cash flow from producing gold, potentially running to around 20,000 ounces a year, and that will come from their Tarcoola project. The cost for this is anywhere between 10 and 20 million Aussie dollars, and stage 1 should generate enough free cash flow to fund stage 2, which is Tunkillia, 130,000 ounces a year at a current, at a dollar cost of gold of 1,917 all-in sustaining cost. And that comes from a 1.6 million ounce resource. Now, last year's scoping study gives that an NPV of 512 million Australian dollars, 6.4 years life of mine, and payback in 1.9 years. More than 300 million Aussie gross free cash flow annually at the current gold prices, and an optimised scoping study is expected to be delivered in the next few months. Total cost anywhere around sort of Aussie dollars 400 million, which would be a mix of debt around 70% and equity, from what Alex tells me, is a very tight shareholder base. They've also got a 3 million ounce silver resource that they could potentially forward sell to fund a portion of that 30% equity component. Early conversations underway now with a tier 1 bank indicate potential cost of capital circa 8%, which is comparably low for a company of Barton's size. I like the fact really that they only need about 20 million Aussie to start stage 1, convert from explorer to operator, and then utilise that stage 1 money to unlock stage 2, which is effectively, potentially unlocking $1 billion Aussie dollars in stage 2 value. That's huge leverage if they can pull it off. Now, Brazilian Rare Earths, that was a company I'd never met before, and I got talking to them. They've got the biggest rare earth deposit in Brazil, 45.7% TREO, that's total rare earth oxide. So to put that into perspective, most rare earth deposits are probably around 10% or under 10%, with top ones like Lynas or MP Materials closer to 7 to 12%. So 45.7% is massive. means more valuable stuff per tonne effectively. They're well cashed up with 82 million Australian in the bank, 94% recovery from mild sulfuric acid tests in the MET testing, and that's very important for rare earths that the MET test actually works. And a JORC resource plus scoping study are coming by late this year. They're also eyeing a New York Stock Exchange listing after maybe a Q3 raise too. Uranium credits are a bonus, although regulated in Brazil, but I'm excited about this one because I do like a rare earth play. From speaking to the CEO there, this one feels like it could very much be a tier 1 asset in the making. Now, Metalla royalty and streaming. I didn't take notes on this one because it was a presentation that I was chairing, but I remember their pitch. So they're into gold and silver royalties. Basically, they fund projects and get a cut without running mines themselves. It's a lean, smart way to ride metal prices higher. Their portfolio is spread out in the Americas and Australia, and the team seems pretty sharp. I like it because it's less risky than straight mining. They have 100 assets with 6 currently producing, and their top 10 assets have a 20-year life of mine. It's a good early-ish stage royalty company that has longevity and upside, with analysts valuing the company roughly double their share price today. So definitely one to watch if you're into precious metals and want to take a less risky approach through a royalty company rather than an explorer. Now finally, and at the sort of smaller end of the valuation, is Fury Gold Mines, focused on high-grade gold exploration in Canada, places like Quebec and Nunavut. They've got the Eau Claire with a solid resource base, plus a big land package like what they've got at Committee Bay. They haven't been fully tapped yet. The team's got a strong track record and they're all about growing ounces fast. They've got a program underway now, so if you're into gold exploration with potential, I think Fury is indeed worth a look. Lower end of the market, but higher potential upside. So that's just a few of the companies that sort of caught my eye as I was going around the Swiss Mining Institute, and I'll be definitely keeping an eye on them myself throughout the course of this year.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.